Hello and welcome back to another exercise relating to acquisition of assets. In this case, we're looking at tangible assets, but we have a lump sum purchase and we have two different scenarios we're looking at. So let's start with the first basic information given over here. Samtec Manufacturing has purchased land and building for a total of $4 million. In addition to this purchase price, they made the following expenditures. The title insurance is $16,000. Legal fees for drawing up the contract is another $5,000. Prorated property tax for the period after acquisition is $36,000. State transfer fees is $4,000. Then they tell us an independent appraisal estimated the fair value of the land and building if purchased separately as follows. Land is 3.3 and building is 1.1 million. Shortly after acquisition, the company spent $82,000 to construct a parking lot and $40,000 for landscaping. So lots of information given over here. Let's do part one. They've asked us to determine the initial valuation of each of the assets acquired in these transactions. That's land and building. So let's take a look at what we have over here. We have two assets we've acquired. We have paid, the purchase price is $1 million. The purchase price, let's start out with, sorry, it's not $1 million, $4 million. We paid $16,000 for the title insurance, a one-time cost. Legal fees, $5,000. The $36,000 will not be included because it is after acquisition. Property tax is an ongoing expenditure. If it was anything relating to prior to the purchase, that is, if it was outstanding debt, we include it on the cost of the asset, but this is going to be excluded. The next we're going to include is the state transfer tax that gets included. So we have spent a total of $4,025,000. That's how much cash we have paid. Now we need to allocate this to land and building. We have two assets, land and building. Okay, so let's see how we're going to do that allocation. The allocation for land and building. If I had purchased the land and the building separately, the appraised value is 3.3 and 1.1 million for a total of 4.4 million. So here's what I will do. 3.3 divided by 4.4 is 75%. 1.1 divided by 4.4 is 25% for a total of the 100%. Now I take that number that we have, this 4,025,000. Let me highlight that over here. And I bring that number down over here. I need to allocate this amount because this is how much I spent. I did not pay 4.4 million. I paid 4,025,000. That's the total cost. 75% gets allocated of this amount. 75% gets allocated to land. So it's 4,025,000. 4025 multiplied by 75% to land, and the remaining 25% will go to building. That's how I'm going to do my allocation. So land and building, that's my allocation. The total that I paid is 4,025,000. That's a number that I have paid, the total amount. The allocation is based on the appraisal value of the two assets independently. Now I also spent $82,000 on a parking lot and $40,000 on landscaping. These numbers are not going to get added to the cost of the asset. They are land improvements. I paid for land improvements, and that amount is 82 plus 40, which is 122. We need to put the dates over here. We were not given dates, so we just put XX over here for now. Once again, I purchased land and building. First, see how much of that should be capitalized. The amount you did not capitalize was property taxes for after acquisition. That doesn't get capitalized. So you excluded that. All the other numbers are added up over here. The appraised value is 3.3 and 1.1. This is a lump sum purchase. So I go with the proportionate amount and then I allocate the actual cost over here. Land improvement is anything that I've done to enhance a land but has a finite life and it's not going to be there forever like land. So your parking lot and your landscaping, they have finite life, hopefully at least a few years that you can depreciate it over. Okay, that's part one of the problem. Let's look at part two. They've asked us to repeat what is required in one, that is to do the valuation. But now they're telling us something different. Immediately after I acquired this asset, the land and building, we demolished the building. So there is no building. Demolition cost is $250,000. Salvage materials were sold for $6,000. In addition, we spent $86,000 in clearing and grading the land in preparation for construction of a new building. So we have no building right now. The building that was there, we've got rid of it. So let's go through this exercise again and see what we're going to do. Start with the purchase price. I paid $4 million. Okay. Now let's go through the other numbers. Title insurance. Yep, I add that over here. Next item is legal fees. Yep, I add that. Once again, that $36,000 you're going to skip. State transfer tax. Yes, $4,000. Okay. Now demolition. I paid demolition cost of $250,000. I'm going to add it to the cost of the land. I managed to sell something for $6,000. So that $6,000 is subtracted from the cost of the asset. I paid for grading and leveling $86,000. So the total amount is $4,355,000. So over here, my journal entry is going to be land debit and cash credit, and the amount is the $4,355,000. That's how much I paid over here. Now, the remainder of that journal entry, this land improvement, that stays identical. That's separate from land. I did that separately. So land improvement debit, cash credit, and that is for the parking lot and the landscaping. That journal entry stays the same as before. It's this one over here. If you notice over here, land over here in the first case was $3,018,750. Here land is $4,355,000 and there is no building. In fact, we're going to construct a new building and that's going to add to our cost of what we're spending over here on the long-term assets. So once again, here we are looking at the acquisition cost of land and building in a lump sum purchase.